Well, thanks, Jeanette, and good morning, everybody. Always educational on these Saturday morning Trade Thirsty events, and you've got just some great speakers, as well as I love what Jeanette and the Trade Thirsty team did there for that trade-off. Loved seeing converting the ideas into action, and regardless of the chart, kind of knowing how you're going to respond is really the secret to being effective and staying in the game, frankly, for the long haul, because you're not going to win on every trade. But it's how can you create that kind of leverage like Jeanette was talking about. That's what I want to talk about today is how we use $1 options. These are options that would cost you no more than $100 per contract controlling 100 shares, and oftentimes less, for truly mega leverage and the opportunity for huge winners. Like we said, not every trade is going to win, but in this kind of market, we're going to explain why the opportunity is so good, because options are so cheaply priced, and yet the market, as you know, has run tremendously. The NASDAQ up almost 30% in 2017, and even more since a year ago, and then the Dow up over 20%, and you're paying for 10% volatility, so you're getting a huge bang for your buck. I'll walk you through all that today and show you a lot of examples of what we've been doing in our $1 options or less strategy. Just a reminder as I jump into it that everything that I share with you here today is for your information and education only. I don't want to teach you just enough to be dangerous. I want to make sure it's kind of opens you up to then how you can learn more going forward. But basically, the information presented here should not be considered a recommendation of buy or sell any particular investment. And you know that, of course, you are 100% responsible for your own investment decisions. Big Trends and its staff are not responsible for any trades you make. And not all Big Trends products or services are appropriate for all types of traders and investors. What I'm sharing with you today is a more aggressive strategy. So you could lose what you put into a trade. We seek for that not to happen, but it can happen. And I tell people that going in, because you can then make multiples on that when you're right. Big Trends doesn't provide any personalized financial tax or legal advice to any one individual. What we do with our research in our Grand Slam options portfolio I'm going to teach you about today is we send out those trades to you right before the market opens, and then we tell you how to manage that with targets and stops. You decide how you then want to best utilize it. Make sure you consult your tax advisor too before you make any investment that's going to impact your unique tax situation. As you know, tax bill in Washington, D.C. changing rapidly. It seems like every day something new has been popping into it. Hopefully they get that hammered out, and then it's a great time to talk to your tax advisor, because you can do some last-minute year-end tax-saving moves and deductions. Big Trends products and services like our Grand Slam options can be up to 100% tax deductible, so check with your tax advisor. Now, what we're going to talk about today is learning about how do you buy these cheap options. For a long time, I kind of stayed away from teaching traders about this because I didn't think most traders, in my best Jack Nicholson voice, didn't think it could handle the truth of the volatility as it relates to that. Yes, you can truly hit doubles, triples, or even four baggers, so 2, 3, 4 times your money, and in a short period of time. We're going to talk about how, with the gamma approach, looking for options that have a really nice, basically, way that they pick up value very quickly when you catch a short-term trend move correctly. So the trends still matter, and that's why the name of my company, Big Trends, I started in '99, and have been teaching people for the last 18 years how you can position yourself for whatever the market provides you. We're going to talk about some of our favorite filters today, the CCI, what I call the Big Trends bands, which gives you a really interesting way to look at kind of the trend as it adjusts, and the ADX, which I'm sure a lot of you are familiar with, the average directional movement, and an overall review with case studies on my aggressive options strategy, including wins and losses. Now, when you add up the wins and losses since the beginning of the year, so you start at the end of December, you go to the end of October, we were at 15,703 in gross profits. That means add up all the gains and losses before commissions. We're not doing more than about maybe 7 or 8 trades a month, never more than 100 trades a year. And so you can see that even after commissions, even if you're paying too much for commissions, you're going to have a lot left over. But we don't want you paying too much for commissions. We can help you there too if you're looking for brokers that can get you in and out automatically in these trades without you having to lift a finger. In November, we were actually down at $44, so take $44 off of that through the end of November. We've gained more than that back in December, so ahead of that point to now. I just didn't get a chance to update it. But here's what I want to talk to you about as it relates to the kind of home run potential that you can have with this approach. Here's a trade that we did back in Microsoft back in October. And what we're looking at here is kind of a combination of things. I'm going to walk you through a lot of these examples and explain them in more detail. But we want to see trends that are going overbought, and then a lot of people think overbought's bad. Like Microsoft on percent R and CCI first went overbought right here early October. You can see that we're going into the overbought threshold on percent R up here. We're going on CCI on the yellow line into the overbought threshold. Most people have read the textbooks that say when you hear the word overbought, you shouldn't buy. They think overbought means you should sell it. That is probably the greatest, if I can change your awareness of how we can position you for 2018 and beyond to make truly big money, at least have the opportunity to make big money, you've got to flip that belief that you have that overbought is bad, because when this thing confirms soon after over the next few days, we're getting in there that morning of the 12th of October, and we're buying a Mr. Softy, Microsoft, the November 80 call. So we were buying out just a little over a month to the expiration, and we were buying it, in this case, for $55 a contract. So that meant that to control Microsoft shares when they were trading about $77, we were saying, you know what, for $7,700 of controlled investment, we're only paying $55 per contract. You can see, by definition, that's going to give you more than 100 times leverage against the underlying stock. So when Microsoft made a relatively small move and popped up here about, you can see 7 trading days later, it's popped from about 77 to just under 79. We're taking a double on half our position. Now, our usual rules are that when we can take a double on half, the great thing about that is you get your risk capital back. You can truly have a free trade at that point. Even if the other side of the trade crapped out to nothing, you'd still be breaking even before commission. So obviously we don't want that to happen. But in this case, as you can see here, Microsoft had earnings in late October. The stock was still holding its support line here, this light blue big trends band. We're going to explain that here, what we're looking at there, but it's still holding it, and we're saying, look, we're positive on this trade. We've gotten all of our money back. We're going to go ahead and free roll into the earnings and take our chances. If it gaps down, we can see that other side go out at no value, and we end up breaking even on the trade. Instead, it gaps up a lot more than people expected. The stock before the close of the earnings was just under 79. It opened at 84.30. We sold those 80 strike calls for $4.71 in at 55 cents. That was a 756% gain on the second half of our position. Usually we targeted 200% and then a 300% last 2 quarters of our position. So the gap up afforded us what we would call a windfall. I think anybody would call that a windfall. And that was on the second half of our position. So you got to add up the 100 and the 756. That gives you 856 divided by 2. We only got 428% on that trade. You know, that's the kind of thing, like, you don't want to think all or nothing in trading. Most people I see are taking that kind of all-in mentality too much on their trading account. And that will, even if you're right, even for a streak of trades, you'll eventually get blown up if you do that. You've got to have sound money management. The first rule of trading is get your risk capital back. And that's the only time I will hold a trade into in front of earnings and after the earnings is if I've got all the risk capital back in my pocket and in your pocket. So our Grand Slam folks, you can see, hit the home run on that in 11 trading days. And we're done at that point. Microsoft basically backed and filled until the past week it started to go again. We caught it in another service for a 50% gain in about 25 hours for another program. But we're looking for those bigger gains. And so, again, we break it down month by month. And this is assuming, by the way, that you're not putting in any more than, in this case, $1,000 per trade. Okay, so when you're looking at this and you're saying, okay, I'm not putting in more than $1,000 a trade, then basically I'm saying, okay, and then, like I said, 7 or 8 trades here max. We're basically looking at a situation here in which, yes, we've had a lot of big individual months, some that were smaller wins. September was clearly our worst month. So we gave back about what our best month would be, or a little bit less than our best month in September. October made it all back and then some, and still had $800 left over after you made up for the September gain. So one of the things I also tell people is that if you're, say, you know what, you're looking for more of an income strategy, growth's not for you, it's too volatile, whatever, one of the strategies you can do is you can say you started with a $10,000 account and then you started in January and you made $2,300, or even say you netted out $2,000. Whatever your net number is, go figure it out and say, okay, you know what, I'm up a couple grand plus for the month of January. I'm going to write myself a check at the end of January, beginning of February for $2,000 and keep my portfolio value where I started. So you could basically be peeling off more months than not in this case. We've had 8 now out of 10 months profitable. I tend to tell people, look, even if we have half of our months profitable with this kind of an aggressive greater upside than downside strategy, you're gonna be a pretty happy camper as a long-term Grand Slam option subscriber. Like I said, we call these all out in real time, and we tell you always when to get out as well. We never leave you hanging. So everything's included here, gains and losses on every trade. We called out in 2017, for better or worse. And you can see, you could be peeling off really nice monthly returns, more than double-digit returns more than half of the year, you can see in this case. Now, what I would have said in September is, let's say you peeled all your profits out and then September hits and you go from 10 grand down to just under 7 grand. Well, you're still trading $1,000 a trade going into October, and you just don't take anything out in September. Obviously, you're down. You got to make up that $3,060 loss in October, and so then you're still up $800 net because of that. You made up that $3, and you got $800 left in October. You could write yourself a check at the end of October for $800 coming into November. So, and November is flat, and then now we're looking positive again in December. So the thought is, this is a strategy where it's not just you shouldn't just pile all your profits in and keep loading up your portfolio necessarily. If you want to take a little of the edge off, follow that kind of writing yourself a check for your profits every month, and when you're down, then make up for that, build back to your original risk capital, and then get back to writing checks when you're positive again. To me, that's a way you can take a growth strategy and make it an income strategy. Now, as I mentioned at the beginning, the opportunity here, it's been unbelievable how low volatility's been, especially for all of 2017. We've been pretty much stuck in a range between a low of about like 8 on the VIX, the volatility index. So it's often called the fear gauge. There's been no fear, basically, and yet that hasn't been a contrarian signal. I've said to people for a long time that you could draw a line in the VIX through 20 and say, you know what, if we're staying above 20, you better be careful. And you know what happened in 2008, and especially into early 2009. We had that just awful plunge in the markets where VIX went as high as about intraday got to about 90 up here. And VIX had been pretty much staying above 20. And it pretty much stayed above 20 until we got into about 2012 and 13. You can see since then we've been mostly below 20. There was that flash crash in 2015, August of 2015, where it started to heat up above there, and it got ugly there for a little bit. And even at the start of 16, got an early correction here where we're like, okay, it's a little bit of a rough period there. But since then, these brief spikes up, you can see into the 20 level here, have basically hit and then flipped right back down. That's a bull market, folks. So we've been telling people, yeah, we've had a lot more calls than puts. We've still scored on some puts, like we got T-Mobile. We'll show you an example on that, or we caught it for a quick double here this past month. But basically, the thought is, when volatility is this low, the opportunity for you is no longer as an option seller when VIX is at 10, give or take. The opportunity is that the S&P is going up at 25% annualized, and you're paying for 10% annualized. Should you buy or sell those options, do you think? Clearly, you should be buying options that have that cheap of a volatility compared to the trend you're actually getting. And so the basic premise here is that you really have an opportunity to, and volatility is staying low. It's continuing to, it'll have brief little pops, but basically on the big picture, you're buying cheap options here when you catch the trend moves correctly. Now, I'm talking about this Grand Slam home run-based approach, and when I think about home runs, I think about Babe Ruth because, in his day, we all know he was the home run leader. His 714 career home runs was not eclipsed until Hank Aaron did it in the early to mid-'70s. But what I thought was interesting, when you look at his all-time stats, he had almost twice as many career strikeouts as he had home runs. And yet, he won like 6 titles, technically 7, but I didn't count that one on the first one on the Red Sox before they traded him foolishly to the Yankees. Basically, he didn't play that first season when they won, but next 2 World Series with the Yankees, with the Red Sox, and 4 more with the Yankees. Talking about a big-time champion in about 14 seasons, and he said, how does he hit home runs? He swings as hard as he can. He swings big. He hits big or he misses big. We want to try to limit our misses here. I like to live as big as I can, but I love his quote here next to his picture. Never let fear of striking out get in your way. See, a lot of people are so fearful because you've had bad experiences in your own trading or with somebody else, and so now you have what I call a scar tissue. You've got this sort of a fear of failure, this sort of skepticism or worry that you've got to figure out how can you discharge that and start taking advantage of what the market is putting in front of you, knowing that you're going to have trades where you do strike out, but knowing that when you hit these home runs, they can carry your portfolio. Even a small part of your portfolio can truly become the growth kicker that a lot of people have been missing. And I've talked to a lot of folks that come to big trends who are holding way too much cash. You know that cash has been trashed for years, and regardless of what your thinking is in the market next year, you know, we've been in a monster bull trend, of course. We're going to get sharp dips along the way, I think, but there's going to be opportunities on both sides. Now, this is kind of a scary picture of this gorilla here, but I do that for a reason to say you don't want to ignore the 800-pound gorilla in the room. And the 800-pound gorilla to me is institutions. Institutions are the ones who are driving the markets, and they're driving these stocks to unprecedented heights. And when they start bailing, they'll start driving them down sharply too. You've got to know that those institutions can't get in and out of positions simultaneously or quickly. They've got to build their broader, bigger positions gradually over time. It's sort of like if the 800-pound gorilla here jumped into the baby pool, they jump into a cannonball, they splash all the water out. You know, there's nothing for anybody else to swim in, and it wouldn't be fun for them either. You know, basically they tiptoe in and move in and out gradually, so their effect is not as noticed. But there is a fundamental catalyst that really drives these 800-pound gorilla institutions, and that's earnings surprises. When you get down to it, institutions are like you and me. They want to have more pleasure and less pain. They want to be in things that are working, and it'll keep piling into the upside on great-looking earnings, and it's particularly positive reactions to earnings. If a company has quote-unquote great earnings, they're above expectations, and the stock drops in the day, I don't grade that as a positive surprise. If anything, that's a negative surprise that it dropped on good news. So I'm looking for things that are going up even when people didn't expect them to go up on their earnings. That's telling you that the institutions are going to want to keep having what we would call prolonged buying, or in the same way on the downside, something misses and disappoints, they're on the wrong side, they don't want it that much pain, they're going to, every bounce, they're going to bail on that thing typically. And so the lesson is go in the direction of the earnings surprises and never fight them. Never rationalize, oh, well, the stock was down on the day, but the news looked great. I'm gonna buy into that. That's a mistake. You're gonna be on the wrong side of the 800-pound gorilla there. Now, also, one of your opportunities here when we get into the whole concept of the options model and what's your edge against the options model. Does anybody know, quick quiz question, you can type it in the chat box, does anybody know the guys that won the for the Black-Scholes options pricing model, which was actually 3 different key individuals that really drove that, where did 2 of those 3 guys go after they won the Nobel Prize for the options pricing model in 2007? They went to a very prominent hedge fund. I'm just curious if anybody has a memory that far back. It's been now about in this case, 2 decades since this happened. In 90, it was actually 97 into 98. Excuse me. That's right. James is in there first. I'll give you another second to think about it. LTCM are the initials, and at the time was the biggest hedge fund going, called long-term capital management. Now, that was an ironic name because they were using short-term option strategies and betting on basically that trends didn't exist and that everything, quote, reverts to the mean. It goes back to the average. This philosophy is what the options price model is based on, that they won the Nobel Prize for, so say in 97, and then basically in 98, they almost blew up the financial system. How? Because they were taking huge leverage bets, not just in options but in swaps, and betting that trends that were going in like the Russian ruble and foreign currencies, that those trends were going to reverse, that those trends shouldn't exist, couldn't exist, and have to revert back to the average. What happened? They were wrong. The trends kept going, and they about blew up the financial system. At the time, Lehman Brothers was rumored to be insolvent. Of course, we know a decade later, Lehman Brothers did go out belly up from selling out of the money puts and making bad bets like that. That worked until they didn't. So don't ever sell naked options. I don't recommend that. That's what blew up firms like Lehman Brothers. But the point of this is they're pricing options based on this normal distribution where essentially on the left they're saying things should stay near the current price, the zero line, average or mean, more often than they actually do. The real effect is that they're not saying near the current price much more than 30% versus the 40% expected. And then the tails that you can see here, like if we look at these 2.5 or 3 deviation moves, they say those shouldn't be happening basically. Those tails are really thin. You can see in reality they're a lot fatter or thicker than what the market expects. And so when you look at that, you say, okay, that doesn't look like a huge difference, but that's your edge against the options pricing model, is finding trends. One interesting stat I pulled out here is if you looked at the daily S&P 500 return, looking for a 3 sigma, 3 standard deviation event, theoretically that should only happen like 1% of the time. In this case, for the S&P, it would be like a 3.5% drop in the S&P. It says, based on the typical Black-Scholes model, it's saying it should happen 27 times in a century. In reality, it's happened more than 100 times since 1927 in the last 90 years. So it's happened basically fourfold compared to what's expected. So do you see that the opportunity for these bigger than expected moves is definitely not priced into the model, and you can get a huge advantage here. Now we talk about indicators. I don't have to develop every indicator I trade. My philosophy is if it tests well and it works, I want to leverage it and I want you to be aware of it. And so one of the ones that I really like on this overbought theory, staying overbought, is the commodity channel index. Now, based on the name, you would think it only applies to commodities. I use it on stocks and markets all day, every day. And I use it longer term. I use it intraday. I use it on a lot of different time frames for a lot of my big trend services these days. It was developed in the early 80s by Donald Lambert, who was studying commodities, and I was thinking that he was looking at, like most people initially, like, oh, it goes overbought, bet on it going down. He realized quickly that the best opportunities were when it breaks out and stays broken out to the upside for buying or to the downside for selling. What's interesting about CCI is it actually measures not just the closes. That so many indicators just focus on the close. Lambert took the high plus the low plus the close, divided them by 3 to create what he called the typical price, and that was more telling than just where it closed. Like we said, overbought can be very bullish, oversold can be very bearish. We'll show you some examples here in a minute. Also, we're going to look at the ADX that Wallace Wilder developed, same guy that developed the RSI indicator, and we're going to show you how we make money, Gilbert, in just a minute. We'll show you a number of examples. Got to lay some groundwork, got to build a foundation before we build the rest of the house for you. We're getting there. ADX basically shows you the trend and shows you when something's trending. The criticism of ADX is that they say, well, it doesn't show you what direction it's trending. What I do is I overlay the positive directional movement, or DMI plus, shows you the net new highs. The DMI minus shows you the net new lows. And if DMI plus is above DMI minus when ADX is going up, that's going to be very bullish. If it's going the other way, the DMI minus shows more new lows than new highs. ADX starts trending. That's going to be bearish. We'll show you some examples of that too. We create Wilder created a percentage on this, so you can compare every stock against each other to look for the relatively better ADX moves. Now, one of the innovations I had when I looked at Larry Williams' percent R indicator, which is this example here where it goes overbought in red and stays overbought, this is on Baidu on one of our Grand Slam trades, is we basically said, you know what, if we took Larry's just plot below and said, I'd like to plot the equivalent of the overbought threshold on the price chart itself. And you can see it's adjusting as the trend breaks out to new highs. This blue line is the upper big trends band. It shows you that when it's in between those bands, I don't want to trade it. That's the noise. That's the chop that's too unpredictable. You can see once it started to break outside of here and kept going, that was our confirmation day. We were buying on the open right there for Baidu. And you can see for the options, just a day later, by the end of the second day, we're already at a double. These are out of the money, 2 10-strike calls. And basically you see about 2 days after that, we're at a triple, and then a day after that, we're at 300%. So in 4 days, 300%, because this thing's going straight up. And you can see I left money on the table. It kept going up. But my experience has been is that, you know, once it gets up to that 300% final target for us, sometimes they'll keep going and sometimes they'll give a bunch back. So we found that for people's sort of greater consistency and greater good, it makes sense to take those gradual profits as we go. Again, you can see overbought on the red line down below, the classic Williams percent R percent range indicator is telling you that it's staying overbought. That's in a very powerful uptrend. Once it comes out of that, then it's anybody's guess. It's back into the uncertainty. Oversold can lead, we'll show you some oversold examples, can lead to bigger problems on the downside. Now, when I overlay my indicators underneath what I just showed you there, you can see there's your percent R going overbought, and then we got the confirmation there a couple days later. CCI, the same time, is going overbought above its overbought threshold a day after that. Sometimes they don't happen on, a number of times they don't happen on the same day. And then the ADX pattern down here, the ADX is in green, and the start of the ADX pattern I want to see is I want to see it start to tick up here, and then I want to see it keep on breaking out through those highs. ADX actually signaled first here, which is a little bit unusual, but that can happen. By the way, notice during that uptrend, ADX didn't roll over until way back here. Now, why don't we ride it all the way, like I said, because, you know, we find that sometimes it'll still pull back on you before ADX turns. So we want to be proactive and yet we still want to catch major pieces of this trend. But you can see that CCI, percent R, and ADX are staying good there for about a month on this one, even though we were only in it for 4 days. You know, when you buy out of the money options, of course, you're buying all time premium, and that's like a melting ice cube. We want to make sure the trend is overcoming our loss of time. Speaking of that, when we talk about the Greeks and the options pricing model, where should you focus? You know, when I got started teaching people via big trends in '99, I've been trading since 1990 after I graduated from Duke University. And basically I said, you know, and I made the early classic mistakes. I thought I knew it all. I thought, you know, basically, you know, once I'd done my analysis, that my analysis would eventually be proven right. The market just needed to wake up to what I was seeing. Wrong. Basically, you know, so I realized, okay, you know, got to get in tune with what the market's doing, and that was a lot easier to trade that way. And then I said, you know what, I want to be conservative when I launched big trends and started teaching people to trade high delta options. These are options that are in the money that don't have as much theta or time risk. But the problem is you don't have a lot of basically juice in those options in the form of gamma. That is how fast the rate of change of delta will pick up. Once you've got a lot of delta, it can't pick up that much more delta. When we have relatively lower deltas, slightly out of the money options, we can actually see that the deltas will pick up dramatically. And while we have more theta risk with out of the money options, we've got a lot more gamma boost that can overcome that time loss. So this is what we're doing, is buying somewhat out of the money options to get the bang for the buck. And to buy them for $100 or less, $1 or less is the way they're quoted, that basically you're talking about, you know, by definition, they got to be out of the money. I'm staying away from volatility approaches here because I don't want to mess with volatility changes, and that means I should stay away right in front of earnings. So I won't buy something unless I've got at least a couple weeks to go before earnings, and then if I don't get a move in my favor in the first week, I get out before the earnings. I don't want to be affected by that implied volatility collapse after earnings if I haven't already gotten a double on half my position. So another name that's not necessarily a household name, it's one of my favorite commodity names to trade, is GOLD. This is Randgold Resources. I've been talking about this one for over a decade because back in the earlier 2000s, they sold one of their mines, and instead of going and buying another mine, they actually bought longer-term warrants, which are like longer-term options on gold to basically create a more leveraged kind of a gold stock name than your typical gold mining name. They still have some gold mining interests, of course, too, but basically this one's got more leverage. When it starts to move, a lot. Now, it's interesting because you can see percent R and the big trends bands are starting to show some breakout in here. You get a question mark about should you do anything, but CCI didn't actually try to break out until back here, and that was not confirming. We didn't get a confirmation on all three of these together until you saw the ADX turn up, the CCI and the percent R were already turned up right back here. That was in late August. You can see at that point, the stock is getting ready to take off. In 2 days, it actually gapped up past our 100% target. We take half off at 160%. That's guaranteed you a profit at that point, even if the other side went to nothing. You see how it cools for a couple of days, but see how it's holding this big trends band here. It's kind of ratcheting up there. And then you see, technically, sure, it's starting to break, and we could have gotten out a few days later, but we hit our 300% right there, and that's where we said, thank you very much. It doesn't automatically call the top when it hits 300%. By definition, it could keep going. We've just found that sometimes it'll give it up, and so that's why we've made that our final termination exit point on our upside profit targets. So then we're done with it after 8 trading days. Now, again, we've got to be careful with the options that we buy. I never do this strategy on options with 1 or 2 weeks to go because the time decay over here is too great in the final couple weeks before expiration. So one of my rules is if I'm still sitting in a trend that's working but I haven't hit my final targets, I always close my positions down when they have 2 weeks to go before expiration, no matter what, win, lose, or draw. So we'll never hold it into expiration. We're usually going into this somewhere in that 30 to 45 day sweet spot is sort of where we like to get in because, yes, there's a little bit of decay there, but it's not as dramatic as the decay that's happening in the final week or two. Why not buy options that have, say, less decay with 4 months out? If you do that, you'll basically never be able to buy something that's going to give you the kind of leverage because basically, you know, say I buy an option here that's trading around $1. These options would be trading around, say, $4. So the thought is, you know, we've got to be in the neighborhood of saying, okay, let's go out of the money, but not so far out of the money that just becomes ridiculous, the move we've got to get. We want to be able to get relatively quick pops that can make our double, triple, and ultimately four-bagger before we hop out. I mentioned that gamma example before. Here's an extreme example of what gamma does to your option. Like I said, I would trade something that's out further in time, but the most extreme example here is the one-day options right before expiration, just to show you how dramatic gamma can be. If you've ever heard of gamma risk right before expiration, this is what the red line shows you. If you bought a 50 call, whether you bought or sold it, it would have a lot of movement potential, because basically you buy a 50 call with a day left, and it's telling you that if you go from 50 to 51, you know your first delta here is about 50%. So you should pick up potentially about you know, a 50% pop in the underlying should be worth about $0.50 in your option for a move from 50 to 51. What gamma shows you is in the move from 50 to 51 to 52, in this little move here, guess what? When you've got a gamma of 43 at that peak right at 50, that means that, sure, it's got an initial delta of 50% going from 50 to 51. Your next move from 51 to 52 is going to have a delta of what? 50% plus the 43 gamma equals about a 93 delta that it'll have in that little move right here from 51 to 52. That means you'll get basically a point-for-point move in your favor if you were able to catch not just a one-point move, but a two-point move real quickly. Now you can see it works both ways. If you go from 50 to 49, then yeah, you're going to see that your next move down is going to have like a gamma of 7, and so meaning that just to get back to 50, it's saying you've got a very low probability of going in the money on that final day if you are wrong by a point right away, right? So that's why trend is so important in this approach, okay? Now, we don't buy those options. We go out somewhere, not quite 60 days, but maybe in the neighborhood of about 30 to 45 days, and you can see then the peak gamma in purple here is shifted to slightly out of the money. So now, while the gamma is not nearly as extreme, you see for the next point move, we're only picking up maybe about 8 more deltas. That's fine. You know, every 8 deltas counts, right? So we're looking for multiple point moves anyway. And so the bottom line is that, yeah, we're still getting a better bang for our buck going slightly out of the money than at or in the money. And we showed you Microsoft before, and the interesting thing on this is this shows you, I was showing people what was happening and talking about it before the earnings came out, just to show you that we were still talking about it even though we didn't know what was going to happen with the earnings. Yes, we knew the trend was up. As I showed you at the beginning, it ended up gapping up some 6 points and turning that doubler into a 756% gain on the rest. But the point was we were just telling people, look, we're still in there. The trends were all very overbought in a positive way. ADX still headed up in green. All those things are saying the trend is your friend. Let's keep riding. And, of course, sometimes we're going to be wrong if it's an earnings play, if we've already taken our double on half. But we think that the trend odds will favor us because it's about money flow, isn't it? I showed you before, the institutions are the 800-pound gorilla. The idea here is that this is all about, catching these major moves. Now, the right kind of names you got to trade on this are important. I don't want to be doing this on cyclical stocks like International Paper and choose your cyclical industry. I want to do this on more of the techs and the trend and the growth names that are going to have more trend consistently. There's a few that can pop up there that have some economic sensitivity, but most of the names here you're going to see are names you probably have traded or know within the growth space. You can see from Alibaba, Baidu, Broadcom, we've got a lot of tech in there, right? Microsoft, I just showed you. NVIDIA, of course, these are kind of like the new age FANG names. These are the names. We already have a FANG program, and so basically, let me go back to that. We have a FANG program, but so I don't really focus on the FANG names here. You could use this strategy with FANG as well, but the key is that I'm using this on daily charts. I'm not trying to do this as an intraday trade. I'm trying to do this for a multiple day, multiple 100% type of an opportunity. Also, see some of the other names that pop up like MasterCard and Visa. I love the credit card issuers because they're like a license to print money. As every person who's presenting here can attest, when we take your money via credit card to subscribe and invest in the services that we offer you here, the credit card issuer takes a cut out of us, usually a few percent. That's like easy money. They're just taking money off of all the providers out there, and so that's making them like cash cows, okay? My philosophy is, okay, they cost me when I do business that way, but so many people want to do business with credit cards. They say, well, I tend to make it back in the cost that I have with credit cards with the profits that I've had in trading calls on Visa and MasterCard. You can see also like Las Vegas Sands, we just had a double on LVS earlier in December. So basically, we love that kind of name. We even, I didn't list it here, but we even doubled Southwest Airlines, ticker LUV, here about a week ago, and then trailing the stop on the rest. So we've already had a couple of nice doubles here this month. And we'll show you some examples of that. And I want to talk about not just winners, but I want to talk about losers. Because even when you're right on the trend, I know a lot of you can relate to this, where you've been right on the stock trend, you bought options and you still lost on the options. And that's why a lot of people swear off options buying, because they think, oh, that's a bad game, I'm going to stay away from that. Like, and for example, on Tesla, here's an example where, we took those first two trades. We did not take this buy setup on %R here, because look at the CCI. CCI was not where we wanted it. ADX was not where we wanted it. That was just basically kind of an early warning that did not confirm. So when the 2 of the 3 started to confirm back here, notice what's happening. ADX is not crossing, even though it's turned up, it's not crossing up above that red directional movement line. So that was saying it's not trending strong enough yet, so we stayed away from that. But these other ones here, where you got that ADX trend kicking up here, you got that CCI and %R following through, 2 days later, we would have gotten into this one, except it gapped up. So when we bought in on the next, what we call a retest right here, you see it looks like a pretty good entry right there, doesn't it? And about the second week of April, we're starting to make some money here, but we didn't get enough of a move to get a double. Then it comes down here in early May. By the time it's back up here by the end of the first week of May, the stock's up a little bit, and we're not anywhere close to a salvageable value with Tesla, because those options are so expensive. And so by the time it hits its May expiration, you know what? We end up with a trade that gets wiped out. I point that out because we're going to have some of those from time to time. They just don't move fast enough, and even by the time we're trying to salvage the value too, if it's only trading at like 10 cents on the dollar, I'm not going to just sell that after commissions for just a few % left. That's silly. I'm going to hang in there and see if we can get a pop and get you out better. But if we can't, okay, fine. We eat that last 10 cents. It's a wipeout. That happens. And it doesn't happen often, but it happens that I tell people, look, you better prepare for that, so don't overcommit your capital, even after a great run of trades. This next run you see here was a double, a triple, and a quadruple. So if you didn't trade Tesla the next time in late May into early June, and you missed that 100%, 200%, 300% set of targets right there that did get hit, that made up for your loss and then some. If you just say, well, I lost last time on Tesla, I'm not going to trade it this time, you're going to end up messing yourself up. You can't be reactive like that. And then we pass on that other one because it wasn't a good setup. What about on the downside? Here's Schlumberger on the downside, the oil services giant. And Schlumberger gave us a signal when everything started to kick here in late April. So you see it all starting to kick into gear here late April to the beginning of May. And you see just in this little window here, it's a double and then a 200% win. And then the rest of it, as it started to pop back up, when we had to get out by the first Friday in May, it was up about 75% on the third piece. So plus 100, plus 200, and then about plus 75. Very happy with that. You can see, trying to give a buy on ADX here on one of our triggers, but of course %R and CCI not there. When they tried to trigger, we didn't have them above their longer-term trend line. You can see also tried again back up in here, not getting through that. So we stayed away from that last one there, which is important. Got to know when to trade and also when to stay away. The other thing that I do at Big Trends, I think is really surprised that a lot of other people haven't adapted this, is it's a lot of work, which is why they haven't adapted it, is that we don't just look at stock charts, we look at option charts. Now, what's an option chart? An option chart shows you the price of the option. Even one prominent option strategist told me, why do you bother? That option chart is just a derivative of the stock chart. So, but options are measuring different things in stocks. They're not just measuring the underlying stock. They're measuring the time that's left in that option till expiration. A stock technically has no expiration. They're measuring the volatility in that stock. The more volatile the stock, the more expensive the options. So it should be a double yes that the options are different than the stock chart, and you should be aware of that, because you know what happens if the stock doesn't move much, stays relatively flat. You buy an at-the-money or out-of-the-money option, your option is going to expire, and you're going to lose to that theta time erosion, time decay. We don't want that to happen. In this case, what I look for with option charts is they show me, we'll look at an example at Goldman Sachs, they show me when the trend that we're making is overpowering the loss in time. Okay, so there's a battle going on. We all know it intuitively. Trend versus time, which is stronger? If the trend is stronger than the time loss, you're going to see your option chart going up. If the trend's slow, you're on a slow boat, then basically the you're going to lose in your option even though you're right on the stock. So this is what the option chart will do, is it'll tell you when are you getting enough thrust to take advantage of this. So when we saw Goldman breaking out, and you see in the case of Goldman stock, the ADX came on a little late here. It came on by the close of that bar, so we're buying at the open, the next bar here. And Goldman in just about, you can see 4 days, is hitting that quick double in the first half, and within 7 days, our break-even trailing stop on the rest was hit. So we averaged a 50% gain on the total position because it just didn't get the follow-through extension after the first double. Okay? So let's look at the option chart now in comparison. Check this out. So this is a case where I can actually say, okay, if you take the daily options chart, I don't have enough data there. You can see my percent R and my CCI aren't even quoting it because there's just not enough data on this one. But when I looked at it on the 30-minute chart on this one, you can see some really interesting stuff happening. The percent R is broken out through this little window here, and you can see we're getting the double on the, if we bought it at 1, the thing runs up here, and then it hits 2. That's where we get our double in the first half at $2. So we're out of the first half. Now, interestingly enough, where's the key test and what I call retest here is when it starts to come down here, and would have told me that if I was using that level, 160 should have held, and instead it breaks about 140 here. So really, instead of being out at 1 on the second piece, I probably should have been out at $1.40 if you're really just following the option chart by itself. I was following the stock as well and say, okay, look, at break even at $1, I've got to say enough. We're out. You see, good thing we got out at $1 is while it popped back to $1.25, it was on its way down to 40 cents. So trends that go up can certainly come down. Like we told you here, the whole principle here is that we want to make sure we're taking advantage of this. I may have time actually to show you a couple of the December examples so you can get a little flavor on how that works as well. So I'm kind of excited that Jeanette gave me a few extra minutes here so I can actually show you some current stuff as well. Now, this was, like I said, through the end of October, 15,703 in gross profits. Again, before commissions. We're not hyper trading here. We will average about 7 or 8 trades a month, never more than about 100 trades a year max. So figure out your commissions accordingly. Like we said, November down $44. So you're still up over 15,600 for the first 11 months of the year. We talked about Microsoft. Now, I showed you that chart I had showed before when it hadn't showed the earnings, but then we showed you, of course, if you came in late. Look at how it stayed overbought. Even right before the earnings, we're staying overbought through all these measures. ADX is not turning down, the green line. All those things were all systems go, even though it had a little, what we call a retest right here into our big trends band. This is what we call a retest. And a retest means it's got to hold that level around $78. It does the next day. It bounces up, finishes back down a little bit by the end of the day, but it's still holding that. And then there's your pop up to 84.30, and the options are out at 471, up 756%. Check out the option chart. I didn't get a chance to show you that earlier. This is kind of interesting because if you're just following a daily options chart, the daily options chart wouldn't have got you in until we were already getting our double in the first half. So if you're just using an option chart by itself in this case, it was a little slow. Why does that make sense? Because we're buying out of the money options. Out of the money options, if the stock's not moving, that time erosion is working against those options. And when the stock starts humming, it'll often take some of those options on a daily chart another day or two to get going if the stock's really humming. You can see in this case, though, the CCI was already there and confirmed back there at about 75 cents. We were in at 55 cents on the first percent R and ADX and CCI breakout on the stock. But bottom line is that you can see now all systems are go on the option chart as well. That's actually a retest on the percent R that holds around $1, and then it goes to open at 471 right there. We're out off that open. It went to $6 intraday and change. We're already out of the whole thing at 471, and then it started drifting back down. So again, I never try to be a perfectionist with this stuff. I just say, when is the deck stacked in your favor? If you're playing cards, the guys that count cards get kicked out of the casino. But you can do this in the stock market legally and counting when the buying power is strong enough to tell you that you've got a major edge buying options. And what I want to do here before I go into some of those other reminders and how you can take advantage of this stuff, is I want to show you an example of kind of what we call out. So you get a little flavor for how this works. And so what we'll do is we'll send real-time email alerts to our subscribers and text alerts now to your smartphone if you want to get those too. And so we'll basically be really crystal clear about how this works. So we'll say, okay, if we're getting in to a new trade, And you can see actually we got into a couple here and basically trailed the rest of our position here. So let me actually show you. This is a good example. I can show you multiple things happening to show you what a follow-up morning alert looks like. We said, okay, we got a new trade here December 1st on Southwest Airlines. We're going to study the option chart on this one, talk about what worked and what didn't here. We got a 65 call. We said buy it at $70 or less a contract. 0.70 is the way they're quoted. So $70 a contract on the 65 call is almost it's about over 90 to 1 leverage against the stock. We had a Broadcom position on here we were trying to get out of. If it doubled, it didn't. That one actually ends up being, a pop down. We told people to get out when it hit a 50% loss. Didn't get filled on it, and basically then took our chances with earnings. Earnings didn't work. So there you're looking at a potential crap out, even though January is still a ways away. We're still holding it, but it's basically one that hasn't worked. I like to share that with you because basically we'll show you how it works, how it doesn't. Same thing happened here on Wynn Resorts. We own Wynn Resorts calls. By the way, these we're out of all these, so we're not recommending that you buy into them, or at least when we're still holding Southwest, we already made our double, so don't buy it now. But basically, the thought is, look, this is interesting because Vegas Sands and Wynn Resorts, Vegas Sands went on to eventually double, and Wynn Resorts didn't fire, and we hit our 2-week point here, and we're saying, okay, it didn't hit it there. Later that day, we said get out of Wynn Resorts on that afternoon of the 1st at 50 cents when we bought it for $1. We took a 50% loss on Wynn. We got a double on Vegas Sands. If you're not doing your math, you might think, oh, that's basically that's a scratch, right? You lose 50% on one, a double on the other. No, if you take $1,000 turn into 2,000, you're up 1,000 on Vegas Sands from that first run to 100%. You're down from 1,000 to 500. You're down 500 on Wynn. So you're still ahead of the game by plus $500. Okay, so keep that in mind. We're going to look at the Southwest Air example and say, okay, you know what? Okay, it's 70 cents or less. Let's see what happened to that. So let's go take a peek here. I'm going to actually pull up my TradeStation. I usually don't share this stuff, but I'm going to give you a little taste of this here. And we'll go ahead. You see, of course, my indicators have been totally bullish, tracking things like the Qs, tracking all the big uptrends. But basically, I want to show you here, for example, if I go in real quick Grand Slam overview and look at this with LUV. Why do we love Southwest Airlines symbol, LUV? Take a look at the daily chart here. And you see there's our breakout happening on %R, on CCI, and the ADX is turning up here. So when those things are all going to the upside, that's good news, right? We want to take advantage of that and say, okay, how do we get a piece of that? You see the last move was a pretty good one too, but the ADX didn't quite fire when we needed to. The CCI was a little late, and they didn't all confirm together. So we stayed away from that last one and avoided that. It actually caught a little downtrend before that. But this move here, we're getting our confirmation here, 12-1. That's where we put out that signal in the morning of the 1st and said, okay, guess what? We got Southwest Air giving us an entry here. The stock's about 60.5 that morning. We're buying 65 calls into January. So that's the 180119 is the symbol. C for call, 65 for the strike. Check out this options chart now. We're buying it in there. We said get in up to 70 cents, and you can see it was trading in that neighborhood of finishing at 60 cents. So we got filled in there at no more than 70 cents. What's a double on 70 cents? It's $1.40, right? We don't put a stop on these in the first 5 days. We say if it's not working for us after 5 days, the stock is against us, blow it out. But in this case, the stock's working for us. We got to $1.30 there after about 4 days, and then there's our $1.40 plus. Open at $1.40 the double. We're taking the double on half there as of the 8th. Where are we sitting as of the close yesterday? We finished at $1.68. So we're going for a triple now of 210 on the remainder, on the next remainder, I should say, and the final remainder would be 280. So you think about that and you compare it to go back to the Southwest stock chart for a second, LUV, and say, hey, guess what? If you look at LUV, you say, you know what? The stock's almost at $65 right now. That means that our delta is up to about 65% on this option. And at the money usually has it's about a 50% delta. At $65, that's at the money. It's about a 50% delta. So what that means is on the next point up, what should our option do? It should go up about half a point. we finish at $1.68, that would make it worth 218. So we need just under $1 right now to get us to our 210 next profit target. And then we would need up to 280. We would need basically about another $1.25. So we need. I know exactly the levels I need to get in order to see my triple and quadruple price targets hit, and we're still in that position. So that gives you an example of how we trade, and we follow up on every trade, win, lose, or draw. Whether it's good, bad, or ugly, we're going to tell you we're holding this, we're out of this, we're taking the loss, we're taking the gain, and the key is what's the result after all those wins and losses. And so from this perspective, you have a situation in which clearly you've had a lot of success throughout 2017, and the question is, people say, well, I don't think 2018 is going to be like 2017. Well, here's the question. Do you think volatility is going to go above 20 and stay above 20? That might change it a little bit. That might make it a little bit harder to buy cheap options. I think we're going to get brief spikes in volatility, but I think that when you look at the trends, my work has been incredibly bullish. Like if I just go through and show you just a simple long-term chart on the Dow. Let's do that for a second. Jeanette gave me a few extra minutes. I got to share a few extra bonus charts with you, okay? And this is just some of the things that we look at, but basically we're gonna actually show you something that I usually wouldn't show. It's a complimentary overview, and that's showing you, okay, when things get a little too stretched, is the market over? In 96 is the last time that the DMI lines got this stretched on the Dow. You'd say, okay, well, that's too stretched. We're up at that threshold. It should stop there. That was 96. That was about the time Alan Greenspan was saying, we're at irrational exuberance levels on the Dow, around 5,500 on the Dow. Guess what? The Dow went from 5,500 a few years later. It was at 11,000. It doubled from a very wise man, Alan Greenspan's comments about irrational exuberance. We're there now on the DMI lines being this stretch. The Dow's at 24,000. Does that mean I'm saying the Dow's going to 48 to 50,000? It's hard to fathom that, but at the same time, it's saying, you know what? When the trend is strong, the trend is your friend. Sometimes the trend is your only friend when you're looking at, how to really make the big money, especially as options traders. So pay attention to that. But also just saying, look, our last buy signal on the Dow for our percent R, just keeping it really simple, was right after Brexit, the middle of 2016. The Dow was at 17,900. We're now at 24,650. If you go in TradeStation, you look at their historical performance for any given system that you're trading, it's kind of interesting, right? Most of the gains, this system was very profitable going back even into the 20s. It looks like we were only starting in 1930, but it caught the roaring 20s bull run too. It also caught the Great Depression decline in 31 through 33 or 4. But basically, you see, of course, most of the dollar gains have happened since 1990. The beautiful thing about this system, it's not just right on the long side, it's also right on the short side. It doesn't make as much on the short side because you've only had 7 short signals in the last century, okay? This is a long-term chart, right? But it's been very effective on shorts and on longs and saying, you know what, follow the trend. The trend is your friend. So I'm bullish into 2018 knowing that I can get pullbacks into the support line, which is down to 23,000. You said, gee, that would be kind of a gut wrencher if we drop down to 23,000. Guess what? It's going to keep trending up, so we probably won't get that low, but we'll get pullbacks, and those will give you opportunities to buy into the dip and take advantage of that, okay? But at the same time, we'll get stocks that are broken that we can take advantage of on the downside. So let me just show you a couple more things here as it relates to just kind of this grand slam approach and how you can really take advantage of what we're sharing with you today as a great holiday special here in a minute. Basically, the boost that you get here with this approach is that you're taking advantage of that higher gamma option that's a little bit out of the money, and you catch the trend effect. You start getting a compounding on your deltas growing very quickly, and thus getting more and more bang for your buck. The option charts, I believe, give me a nice way to see what's an outlier breakout versus what's something that's not really moving enough on the option. I don't want to buy slow boats. I want to buy fast-moving trends. Now, from this perspective, you say that in this kind of case, don't do this on too many stocks. I'm in about just over 40 different stocks that I follow with this approach. we'll probably cap out at not following more than 50 names. I'll add one here or there where I see some really good historical testing, or maybe a new name that pops on that's really trending up and down well based on our system. These are tailor-made to the system. I'm not going to trade things that are really choppy, really sideways. So, and a question back to the performance, yes, no more than $1,000 in per trade, even with the growth. We don't compound our results. So what we're showing you is not compounded. So really the key elements here for our Grand Slam option service, where we'll update you every day on open positions and then send out new trades whenever we get them within the first half hour before the market opens on any trading morning, is we'll say, okay, there's got to be a catalyst. Most of these catalysts are tied to breakouts and technical action, but you'll see that they've also got to show that the earnings are on our side. So we want to get that fundamental earnings surprise driver where the institutions are going to keep piling in on the upside or piling out on the downside. We're buying the out-of-the-money options that have a greater gamma, and we're never paying more than $1. So you will not see me pay more than $1, period. So that way you can figure, you know what, if you're putting $1,000 in, you can get at least 10 contracts. What that allows you to do is that when we start piecing out our contracts at our profit targets, you can say, okay, if I've got 10, I can sell 5 at the first target. I can sell, say, 3 at the second target and 2 at the last target. However you like to do that on an odd number of contracts is fine with me. But it's just gradually peeling off money as the market makes profit available to us. We do stop trades out if after 5 trading days later the stock is flat or against us. So we say, look, if the stock's not moving like we thought, then basically it's time to move on. You know, the interesting thing about this is that if you look at a name, like I mentioned, LVS, Las Vegas Sands, this was a name that actually, let me show you this chart real quick too. This is kind of cool. This is a name that we got into as it broke out, and then it was still positive, barely so on that retest day on November 15th. We had December options. It was barely positive by the close. Intraday it was against us, but by the close it hung in there. From the buy, you can see where the buy signal happened there at right there at that close, 65.88. You can see it retest, as we call it. That's the percent R retest, the CCI retest. Intraday retest down as low as 64.5, but it closed at 66.25. We stay with it. We're down on the trade there at that point, but the stock is still positive, and then that grind back up into early December is what allowed us to make our double and half our position. Okay, so basically, and then trail the stop on the rest. So the point is, follow the stock. After 5 days, if it's still hanging in there, we stay with it. We don't put a hard price stop on the option. That's a good way to get faked out of your big options winners. We book our gains at plus 100, plus 200, the final plus 300 on a gap, never committing more than 10% of our capital per trade. In this case, say you started with 10K, you could do $1,000 a trade. If you started with 5K, you might do $500 a trade. That would still get you potentially 5 contracts. You got to have at least 4 to do the kind of gradual piecing out of the profit targets. And then I give you weekly video training where I overview what happened with the trades, what I'm thinking about the market, what I'm thinking about what's coming next, and showing you all of the indicators and how they're set up so you can follow along at home as well. Now, what we're doing is kind of we usually wouldn't do this to an outside group, but basically I'm in a very celebratory mood. It's been a great year of big trends and looking forward to even bigger things in 2018. Saying, you know what, there's a couple ways you could get started. You could go 3 months at a time and you could get in for $299. But we did a year special at $895, saying that's like buying 3 quarters and then getting the 4th quarter for free. And I said, you know what, to my big trends community, I'm going to even double your time on that, turn 12 months into 24 months plus. Basically, we're taking you now into January 1st of 2020 would be your expiration date. So you're getting like 24 and a half months here on this insanely good special. So we call this BOGO, buy 1 year, get another year on me. I can only do the BOGO for the 1 year turning into 2 years. Can't do that on the shorter subscriptions. But basically I'm saying, look, now that covers you throughout 2018 and 2019, you're getting coverage to January 1st of 2020 into the new decade coming up for one incredibly low price. And these prices are going to go up because of our success. I can't put too many people in at one time, so I'm going to keep this out there for just a limited time for the Trade Thirsty folks. $895 versus spending actually multiple thousands. If you bought 2 years, you'd be spending almost $4,000. This is saving you like almost 80% off of that, 70%, 75% plus. What you do is you go to that page, bigtrends.com/Grand Slam. I want to go to that page real quick now and show you how you can lock this in. So when you go to bigtrends.com/Grand Slam, I'm pulling it up right now. There we go. And say, okay, check this out. You're going to see this very special offer. We call it Foresight is 2020 because we're taking you to January 1st of 2020, even more than the 2-year value. You're getting this extra 24 and a half months basically to January 1st, 2020. And the key is when you do this on the full year, you're getting this bonus time, and basically you can see how we do things, and you'll learn all the ins and outs, okay? And so you scroll down, you see the kind of gains we've had, Microsoft being the latest home run, but you can see a lot of the gains this year in Randgold, American Tower, Baidu, Valiant, Tesla, NVIDIA, Schlumberger, Chipotle, Wynn Resorts, Amgen, just the list goes on, right? These are real-time alerts. But they will tend to come out before the market opens, especially on the new entries, and then we'll send you how to manage the trade from there with follow-ups. So that way you know exactly what to do. If you want to place a trade yourself, we give you what we call read it to your broker instructions. There's a few brokers that you can get auto trading through where they can automatically get you in and out once you tell them how much money you want to put in at maximum into each new trade that comes out for the Grand Slam options alerts. So if you want that information, you can contact us at our toll-free 800-BIG-TRENDS number, or you can email us clientcare@bigtrends.com. We can get you more information on that auto trade. So you get the weekly video recaps as well as doubling your subscription time. It doesn't get better than an instant double on your time when you can lock that in before prices go up into the new year. So add to cart gives you that best special. You could click the text below and get the 3-month next 90 days try it out for $295, but obviously when you add to cart on the BOGO special, you're getting just over 24 months for just one-time investment of $895. There's no shipping, no taxes if you're not in the state of Kentucky. I know Hubert is right down the road from me here in Kentucky. But basically, bottom line is that when you set that up, you hit the green checkout button. We've already taken the discount to give you the instant double on your subscription time. Turn 1 year into 2. Just get your key information in bold there, and you just scroll down the page. We take the major credit cards. I mentioned those earlier, plus PayPal. And you can just say you caught it on a webinar with me, or if Chris Sarah, my lead consultant, who's been helping answer some questions, helped you, you can give him credit. And what we want you to do is if you want to get it to your smartphone, you can say text the alerts to whatever your number is, okay? Whatever it is, you can go ahead and type it in there, and then we do ask you to tell us what provider you use, whether it's AT&T, whether it's Verizon, whether it's Sprint, whatever it is. Tell us your provider, because we put each of those text groups in separate batch files so we make sure that nothing gets hung up. When we send this stuff out, it goes out real time via email and via text to all of our paid subscribers. So just review our terms and conditions below. It spells out everything, including if for some reason you tried it, it wasn't right for you, you needed to cancel at some point. It is a more aggressive portfolio, so it's not for widows and orphans. I tell people, look, you got to use your risk capital, realize that, yes, you could lose what you put into a trade from time to time, but we can make multiples on that when we're right, and we're going to manage this. This is not an auto-renew program. This is a one-time investment with this incredible BOGO special. So you're going to want to lock that in as well. So just go to that page, review it, and of course, once you've reviewed that, you need to check on as the last action point. Check on the terms and conditions. You've reviewed that, and then hit the green submit order button, and you'll be good to go. Like we said before, if that's out of your price range, even though it's by far the best value, you could do the 3 months. If you just left-click on that text, then you'd have both in there. If you were looking at the other one, you could left-click on that text, and we've got the 3-month in there for actually $295, and you hit the green checkout, go through the same process. But like we said, you're getting like 8 quarters. That's like, even on the 3-month special, that's like in the neighborhood of $2,400 of value for just $895 here today. My way to say thank you to TradeThirsty and all of you all for a great 2017, and wish you a very happy holidays, and get you prepared, not just for 2018, but also for all of 2019, and take you to the start of 2020 with this incredible BOGO special. So I know I'm out of time, so I don't want to cut into, I know another great speaker to come here behind me. So basically, let me go ahead and say thank you to Jeanette. Go to bigtrends.com/Grand Slam to check out that link, folks, and let us know if you have any questions anytime through our toll-free 800-BIG-TRENDS line. We're here to help. And thank you to Jeanette and all the TradeThirsty team. It's always a pleasure, and look forward to working with y'all again in 2018 and beyond as well.